Hello, everyone. Thank you for joining the Ocrolus Product Pulse. My name's David Kistler, and I'll be moderating today's call. And I'm excited to be joined by two outstanding leaders on the Ocrolus side, Lokesh Prakar, who's our Senior Product Manager for SMB, and Patrick Schubert, our Head of Data Science for SMB. Gentlemen, thanks for joining.
Thanks, Tim.
Today, we're excited to share an exciting deep dive, taking a look at Ocrolus products from pre-funding checks to ongoing portfolio management. A few housekeeping things before we get going. Please use the Q&A box in Zoom if you have any questions. We will have a Q&A section at the end of today's session, and so we'll make sure that we save time for those. And if you have any other, comments or concerns, please put those through the Q&A. A quick look at today's agenda. We'll start by looking at some portfolio management challenges through the lens of macro trends and data indicators from the Ocrolus SMB database, highlighting what lenders are seeing across borrower cash flow, performance, and risk signals. From there, we'll walk through how lenders are using docs to digital and post-funding analytics to Ocrolus products to streamline portfolio monitoring, identifying changes in borrower behavior, and surfacing risk signals earlier across servicing and renewal workflows. Next, we'll show those capabilities in action with a short demo, honed for these use cases, highlighting how our insights are surfaced directly within the Ocrolus platform to support faster portfolio review and decisioning within the Ocrolus platform. And then finally, we'll wrap up with some Q&A. With that, let's go ahead and dive in. So, Pat, I'm going to throw it over to you to talk through some of the things that we're seeing on the data side.
Thanks, David. Sure. So on portfolio management, pardon me, we're always looking for signal. There's always a constant conversation, I think, around risk appetite and exposure management as the economic situation evolves. And so I think a place that a lot of people start is in Federal Reserve economic data. What we're looking at here is specifically the two series for charge-off and delinquency among business loans, where we've excluded the top 100 banks. Um, this will usually make financial news and get people's thoughts or opinions on appetite, but it's really not a great portfolio management strategy. You can see where we are today. By this particular set of metrics, we have the highest charge-off rate since April of last year. And actually find the last time it was at about 0.6%, you have to go back to 2012. So there's been a lot of tightening. If we look at the senior loan officers surveys, indicate specifically for commercial and industrial lending, we've seen that a lot of lenders are tightening, but this doesn't give us enough specific signal or action, and it kind of fails at the flaw of averages, as well as for a lot of Ocrolus clients, this is fundamentally a little bit of a different space, right? With MCA factoring, small business lending. So this is an average, a lot of signals muted. It doesn't provide the specific signal needed to take portfolio action when you think about your forward origination, when you think about renewals, when you think about collections and servicing. So a lot of that data, fortunately, does live inside of Ocrolus's network and are anonymized industry aggregate data sets. So what we've prepared a view here on the next slide is a little bit of variation. So in this exhibit, we're looking at the top 12 NAICS codes or NAICS groupings across all of the book volume and application volume that Ocrolus has seen since 2024. And what we're showing with that solid line is the 75th percentile. The reason that we use 75th percentile is we know of a lot of the data we see, only about 25, probably the top 25% will end up in a funded originated loan. And so that's what we're using here to kind of represent what may be the floor or perhaps closer to the middle of different clients' credit box. And what we're seeing in the revenue, the expense, and the spread over time here. And what I call out here, particularly the top of that contoured shape, is the highest value across those 12 industries at a time point, and obviously the lower boundary would be the lowest value. And you can see the degree of variation when you start actually categorizing and looking at cohort performance by specific industry. Um, but that is a power that you get both working with us for with anonymized data sets, and we're always studying it, always happy to advise what we're seeing. But you can start getting really more useful cohort views, whether that's geography, whether that's industry, and you can see the variation here that limited service restaurants usually operate towards the bottom of the spread, but have been on a particular decline since 2025 Q2, at least the 75th percentile, where you can kind of think of the floor of the credit box. And there's been a few winners, right? Electrical contractors and other wiring installation contractors. What we see here is they got squeezed. Their expenses had increased, probably due to the reliance on importing material, and they raised their prices, and then those costs abated a little bit. And so I really encourage anyone who's already using Ocrolus data and processing books and starting to look at more of the analytics and the benchmarking just to understand where a book or an applicant falls relative to a cohort of their peers, to extend that into the way that they think about portfolio management, right? This data can become incredibly useful when you're thinking about risk appetite segmentation, concentration risk. If, as the economic situation evolves, there may be concerns about liquidity in different segments and how the buy box is changing. This is a wealth of data that is already available. And I think Lakesh has a really great example that he will take us through and how you can follow this data into your portfolio management, into your renewal life cycle, into your collections prioritization. So it really serves at both the strategic level of understanding specific to your um, small businesses that have active agreements with you, how their cash flow situation is changing, where your exposure is changing, and what's developing. We can always do that in a ad hoc analytic capacity with you, but the product now really accommodates a pretty nice workflow of how you can use this on specific borrowers to look at how their situation is changing and to trigger actions you may want to take, whether that be from a renewal standpoint to lend where you're really comfortable when you see that they're reaching a natural renewal point, or to perhaps increase your intensity or penetration in a segment with collections action, so you can lower your loss given default and increase your recovery.
Thanks so much for that, Pat. One quick question. If we hear from customers all the time, people are trying to optimize for a more optimal portfolio strategy in terms of loss mitigation. Like, what do you think that looks like when it's running well for folks?
Well, there's a lot of variation in this industry in particular, so it can look very different for different lenders and funders. What I would say is, if I think of gross credit loss, and just using an example, let's say 40% of that is first pay default. Obviously, it's different for every firm, but that would leave me with 60% remaining. And if I have a known recovery rate of 10 to 15%, right? When you're doing portfolio management well, you're going to get two benefits, right? If you can keep yourself high in the payment hierarchy because you're reaching out to them at the right time, you're seeing those risk events, or you're seeing perhaps on a delinquent loan, you're seeing that all of a sudden they've had a large revenue deposit, or the spread increase for them in a month. If you get them at the right time, you stay higher in the payment hierarchy, you could very reasonably increase that 15% recovery rate to 25, 30%. And if you can do that, either receiving extra payments before they go delinquent or contacting them at the right time when they have an ability to pay, it's very reasonable to think, 15% doubled over 60%. That could be 9, 10% of your net credit losses over the year. So it really can be a lever, both from the growth side with renewals, but also to mitigate when you have a well optimized portfolio management strategy.
Yeah, thanks so much for that, Pat. Lokesh, from a product lens, how are we thinking about sort of the core use cases of how Ocrolus, can help funders through, from pre-funding sort of all the way through the life cycle to portfolio management lens?
Yeah, I mean, before jumping into the demo, I quickly want to sort of ground this into how we are thinking about loan cycle and where we fit in. Um, so what you're seeing here is a simplified view of the loan cycle starting from pre-funding all the way through to renewals. And more importantly, how to use the same underlying data and analytics at each and every stage. At the very beginning, in the pre-funding stage, lenders are really primarily focused on risk prevention. This is where we are validating bank statements, detecting inconsistencies, and making sure we are not funding a bad actor. That's where capabilities like Doxo Digital comes in. Once a loan is funded, the focus shifts into active monitoring. Uh, Instead of relying on static data, which is the traditional way of handling things, what we are trying to accommodate here in this product is also how to continuously track a particular business's performance using fresh transactions data as it comes in. As you move further along, this actually bifurcates into two different workflows depending upon business's performance. One is like an early warning signals for which would trigger a collections workflow. These are the signals that collections and servicing teams can act on before a loan actually goes bad. So even if a lender is not, like Pat said, at the top of the hierarchy in the businesses, all of the lenders list, even then, if we are able to track it beforehand, it would help them recover most of the principal amount back, if not less. And then there's the other end of the spectrum, which is where the same data can actually be used to reduce your cost of acquisition per customer, which is by renewing the same business again, and basically helps in retention of the same businesses future loans with the same lender, right? So these are the two bifurcations that we sort of go into later on in after active monitoring. So the key idea here is that analytics is used to make a credit decision, and it shouldn't be stop at just origination. It can and should be used continuously to manage risk, prioritize actions, and identify opportunities across the whole life cycle.
Thanks so much for that, Lokesh. I think that that's helpful to ground us as we jump into the use cases. So let's go ahead and do that.
Oh, sure. 1 second. Let me just share my screen. Great. Just making sure, David, if my screen is visible.
Yep, you're good.
Great. So here I'm acting as a lender right now. I have bank statements data from one of my brokers. I've uploaded it. I've looked at its revenue performance, expense performance. I've looked at its NSF, overdraft counts, total loan proceeds, payments, etc. And I feel good going ahead with funding this. Now, pre-funding, I just want to do a last-ditch effort to avoid any misrepresentation that can be done by editing bank statements. And given that we live in like we have AI tools which are much more capable of editing it in a much more graceful fashion that it cannot be caught. So what we do is basically we upload a plat JSON. This JSON is for the same duration from Jan till December, essentially. But what it essentially does in the background is first it identifies what's the overlapping date range between the PDF and the JSON that you had submitted. This being the PDF analytics data, and then it figures out if each and every of those transactions actually match out correctly with the corresponding transactions on the bank statements. So, and then it highlights all the mismatches which the algorithm is not able to find and corresponding entry for. As you can see, we have a total of 12, 9, and 22 transactions, which are a mismatch. And these are categorized into some buckets called high severity, medium severity, and low severity. I'll quickly talk about low severity since it's like an outlier case, and even we are surprised that this happens so often. But low severity is basically types of transactions where the bank actually on the plat data. So plat data is bank's data. So bank actually posts it on 17th of Feb, let's say, but the statement says that it was done on 16th of Feb. So our algorithm is designed to highlight those inconsistencies as well. We know it wouldn't affect the overall underwriting process as such or underwriting decision, but it's just good to know that all of the inconsistencies are already flagged upfront. And then there's high and medium. So high is any transaction which is like a revenue or a credit builder or any fintech debt or any debt transaction or crypto or gambling transactions. So any of these transactions, if they are found in one source but are not found in another, are basically classified as high severity transactions. For example, this particular business must have paid to $205 for credit builder, but potentially redacted it from bank statement. That is what we could say. And similarly, there's a fintech loan payment that goes out on 23rd of April, but was redacted from bank statement. So this way you can figure out if the representation that is done via submitting the bank statement PDFs is accurate or not. Now, once we have done this, and let's say after looking at all the mismatches, I'm good to go ahead and fund this particular business. I feel like all of the low severity, majority of low severity transactions exist, and I'm okay with funding this business. Let's say that this was done at the end of December. And now what I want to do is I sit in the month of January on 19th of Jan, I want to somehow look into this particular business's data in terms of how the financials or performance of this business has moved. Now, as I can see that there was just one overdraft count, zero NSF counts, total loan proceeds were just $4,000. What I'm going to do is I'm going to upload a JSON from Plaid for 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 the date of 19th of Jan. So let me just do that. I'm going to select run ongoing analytics for monitoring here, and I'm going to upload this monitoring JSON. So once this JSON is uploaded and passed, what it's going to do is it's going to stitch up all the transactions, overlapping transactions, same transactions into one same string of transactions data, unified string. And that way, all of the deduplication happens behind the scene, and then you can look into the uh, numbers, how they have moved. As you can see, a new month's numbers actually popped up here, which is till 19th of January. And you can see eyeballing, you can see that the revenue and expense are roughly in the same proportions, and there's nothing to really worry about here. But if you look at the overview page and look at its total loan proceeds, there's a sudden increase of $50,000 of debt. Maybe that is the debt that I actually gave him, but that's the jump that I can see now here. Now, overall, this particular business still is doing great. I want to still monitor it on a monthly or fortnightly basis. So let's say on 2nd of Feb, I want to run monitoring again. So I just upload another plat JSON, which is for the 2nd of Feb. Once that JSON is um, uploaded and it runs and gives out all the analytics data, we just wait for it to get passed. Once that's done, you can actually look into all of the transactions data and the revenue data on the accounts page. As you can see, for the last week of January, you can see the expenses actually shot up really quickly. And you can see, but in the month of Feb, you can see that revenue sort of caught up and expenses are still down. Maybe it's just because there were just 2 days of Feb's data. And even in the overview page, you cannot see any particular loan position. The fintech loan payments have increased from 10,000 to 15,000. So everything still looks good, but since their expenses shot up towards the end of Jan, maybe I want to keep a closer tab of things. Now, while monitoring, I would now want to bifurcate into two scenarios. The first scenario is a little dark scenario where which would lead into collections. But let me upload a JSON when I'm sitting on April. So for in the month of April, I pull the plat JSON and upload it here. Once it gets paused, let's now look at once again. Let's now look at the overall overview page and see how it changed. Now you see that the last time you checked in Feb till April, there are now 25 NSF counts, 9 overdraft counts. The loan proceeds amount actually went also went up by $10,000. So let's look into accounts and see what's happening there. You can see that the revenue actually keeps on declining since Jan. Expenses are actually going up. So what it essentially means is that there's something going bad with this account and you need to reach out to this particular business to start early collection cycle. Um, this is the darker side of the things. Let me go to the second workflow, second scenario, which is on the sunnier side of the things. I'll just upload a JSON. Same, I'm sitting in on 4th of April and uploading a JSON. While it gets paused, let's quickly let it give some more time to actually see what happens behind the scenes. Guessing it should have been paused by now. Okay, great. So let's go to the overview picture now. Remember, like we had just one NSF count and one overdraft count. The picture is still the same. On even on 4th of April, we just have one NSF count, one overdraft count. Our total loan proceed is also 53,000, which is just 50,000 of our loan and 3,000 existing before, which means that they essentially have not taken a new loan. And even their revenue and expense numbers actually are neck to neck, basically improving their situation from here. This would essentially trigger, as a lender, it would trigger my internal renewals mechanism. Now, what this would do is it would help me retain this this particular SMB's business by making sure that by the month of April, let's say my tenure is 6 months, by the month of April, he must have paid around 75-80% of my loan back. So my paid in capital should have been 75%, 80%. And on top of that, now he's trying to he would be in a couple of weeks looking for a new fresh loan in the market. What if I just target him back and offer him a new loan since his business is performing well? So if I retain his business, offer a renewal loan, it would help me get my cost of acquisitions down. And at the same time, it would also help me deploy more amount of capital back into a validated good business. So that's about it for the demo part, David.
Yeah,
But I'll
thanks so
just
much, Lokesh. Yeah, I folks that are on the call. The Q&A box is open, and we've had a couple of those flow through. We'll get to those in just a second, but just to reiterate the power of what we're seeing from Docs to Digital, as well as the post-funding analytics, is being able to use these products from, like we talked about, those use cases of the pre-funding fraud checked, actively monitoring these businesses' performance over time, and then being able to trigger those early collections or early renewal conversations depending on the health of that business. So really awesome stuff here. Thanks for walking us through that, Lokesh. We do have a couple of questions we'll take really quickly, and then give everybody the rest of the time back. So real quick, Lokesh, do we support from the Ocrolus side other aggregators? I know that we talked about Plaid during this demonstration, but can you just speak to that really quickly?
Yeah, so we do support other aggregators. Some of the other aggregators we have Finicity support right now, and we also have Decision Logic. I'm aware that Decision Logic actually gives out its reports in PDF format, so we do have the ability to pass them as well. So these are two other aggregators that we support, and want to keep on expanding on that.
Yeah, thanks for that, Lokesh. One more here as we look at just sort of the usability of the platform. We got a comment around being able to update in real time, just from updating the JSON. Um, Lokesh, are folks able to refresh those analytics and see those cash flow metrics used at the time of underwriting to compare the business performance several months later after upload?
Yes. So the plaid access token actually lives throughout indefinitely, so we can definitely do that.
Awesome. Any other questions from the folks on the line? Well, we really appreciate everybody joining today. Huge thanks to Pat and Lokesh for driving today's session. All of those who have registered and attended the session will receive the recording and the materials here in just a couple of days as we get everything processed. So once again, thanks from Ocrolus. Thank you for your partnership, and we hope you guys have a great rest of the day.